Don't forget to like and subscribe for more stock breakdowns, earnings insights, and investment content every week. Amazon's Q2 2025 earnings report delivered a mixed bag that left investors both encouraged and cautious, ultimately leading to a moderate price decline. While the company beat revenue expectations, concerns over long-term margins, rising infrastructure costs related to generative AI, and heightened competitive pressure in cloud services led to a pullback in the stock price. Amazon reported net sales of $161 billion, up from $134.4 billion in the same quarter last year, marking a strong year-over-year growth of 20%. However, the stock fell as investors reacted to increased capital expenditures and cautious forward guidance. The company's core e-commerce segment remained resilient, with North America sales up 14% year-over-year to $97.7 billion. International sales improved to $31.4 billion, driven by strong performance in Europe and emerging markets. However, Amazon Web Services, AWS, its most profitable business unit, showed signs of slowing growth, generating $26.2 billion in Q2, up just 11% from the year prior. Margins in AWS also narrowed slightly due to ramped-up investments in AI infrastructure and price competition from Microsoft Azure and Google Cloud. On a fundamental level, Amazon remains a powerhouse with robust revenue diversification across retail, advertising, and cloud services. Advertising revenue was a bright spot, climbing to $13.5 billion, up 25% year-over-year, highlighting the company's growing strength in digital marketing. Operating income reached $12.1 billion, with an operating margin of 7.5%, indicating continued efficiency improvements, especially in logistics and fulfillment. That said, the company's net income margin of 4.8% still lags behind other tech giants, which tempers enthusiasm for aggressive short-term upside. From a cash flow standpoint, Amazon continues to generate significant free cash flow. The company reported $21.7 billion in trailing 12-month free cash flow, a sharp rebound from previous lows during the 2022-2023 investment cycle. Capital expenditures surged to support AWS's infrastructure build-out, especially as Amazon ramps up investment in AI chips and training clusters. While these investments are essential for long-term competitiveness, they will pressure near-term cash reserves, especially if AWS's growth does not accelerate meaningfully in the back half of the year. Technically, Amazon's stock pulled back from highs near $190 to settle in the $172 to $175 range post-earnings. The relative strength index dropped from overbought levels and now sits around 53, signaling a neutral to mildly bullish setup. The 50-day moving average offers support near $168, while the 200-day moving average has climbed to approximately $152, showing continued long-term momentum. Volume trends indicate institutional rotation out of large-cap tech following earnings season. The AI narrative is both an opportunity and a risk for Amazon. Management emphasized the rapid scaling of Bedrock and Trainium-based AI workloads on AWS, but also acknowledged pricing pressure and slower client onboarding for generative AI services. This cautious tone contrasts with the aggressive AI outlooks of competitors like Microsoft, which investors may have viewed as a sign Amazon is lagging in this emerging tech arms race. Additionally, concerns remain around regulatory scrutiny tied to AI content moderation and data privacy within Alexa and other smart devices. A SWOT analysis provides further insight. Strengths include Amazon's massive scale, leadership in cloud computing and e-commerce, and dominance in logistics. Weaknesses include compressed margins, dependence on AWS for profit, and capital intensity. Opportunities lie in AI-driven advertising, automation of fulfillment, and expansion into healthcare via Amazon Clinic and One Medical. Threats involve intensifying AI competition, macroeconomic headwinds, and increasing regulatory focus on monopolistic behavior and labor practices. Despite short-term headwinds, Amazon's long-term outlook remains positive. The company is well-positioned to benefit from AI and digital transformation trends across multiple sectors. While risks from increased spending and competitive pressure in the cloud space are real, Amazon's operational leverage, consumer ecosystem, and financial flexibility support a constructive view. We maintain a buy recommendation with a 12-month price target of $210, representing about 20% upside from current levels. Investors should be mindful of short-term volatility as Amazon continues to evolve its AI strategy and monetization approach. Long-term holders can view this pullback as a potential accumulation point, especially given the company's continued innovation across multiple high-growth verticals.